On November 10th, 2025, Michael Burry, the investor who famously predicted the 2008 financial crisis and made his investors over 489% returns, within hours, financial media exploded. Market crash coming. Burry sees disaster ahead. Get out now before it's too late. But here's what almost nobody did. They didn't read his actual letter to investors. I did. And what he said is way more interesting and way less dramatic than the panic headlines suggest. Stay with me. Michael Burry doesn't do anything quietly. When he makes a move, markets pay attention. Because his track record is unlike almost anyone else's. He called the housing bubble when everyone thought he was insane. He shorted subprime mortgages when banks were still handing them out like candy. He made billions betting against the consensus. So when someone with that history closes their fund and returns all client money, people assume it's a warning signal. A flashing red alarm that says, get out of the market now. But I spent the last week digging into what actually happened. I found a copy of his October 27th letter to investors. I reviewed his recent positions. I looked at what he's been saying on social media. And I talked to people who understand how hedge funds actually work. The real story? It's not what you think. And understanding what Burry's actually doing matters way more than the panic narrative being sold to you right now. Quick thing. Before we dive in, this isn't financial advice. I'm analyzing publicly available information and explaining what it actually means instead of just repeating headlines. If this helps you understand what's really happening, let me know in the comments. And drop what other financial stories you want me to investigate like this. Let's start with the documented facts. On November 10th, the SEC's database showed Scion Asset Management's registration status as terminated. This isn't speculation, it's in the public record. According to his October 27th letter to investors, Burry wrote that he would liquidate the funds and return capital by the end of the year, citing that his estimation of value in securities is not in sync with the markets. Now, that quote right there is what everyone's freaking out about. Not in sync with the markets. People hear that and think, he's predicting a crash. He's warning us. This is 2008 all over again. But hold on. Let's look at the full context before jumping to conclusions. Scion managed $155 million in assets as of March 2025. That's not nothing, but it's also relatively small for a hedge fund. For comparison, at his peak before 2008, he was managing significantly more. So the first question is, why was the fund so small? Burry previously shut down his original fund, Scion Capital, in 2008 after successfully betting against subprime mortgages, allowing his investors to more than quintuple their money from 2000 to 2008. He then reopened Scion Asset Management in 2013. So this isn't the first time he's closed a fund and walked away. What's he been doing lately? This is where it gets interesting. Burry has stepped up criticism of technology companies, including Nvidia and Palantir in recent weeks, questioning the cloud infrastructure boom and accusing major providers of using aggressive accounting to inflate profits. He's been particularly vocal about what he sees as accounting tricks. Between 2026 and 2028, he estimates companies could understate depreciation by about $176 billion, inflating reported profits across the tech sector. And he's not just talking. He spent about $9.2 million buying put options on Palantir that let him sell shares at $50 in 2027. That's a big bet that Palantir's stock, currently trading much higher, will drop significantly. So we have a guy who's bearish on big tech, thinks the AI boom is overblown, sees accounting problems everywhere, and just closed his fund. That sounds like a market warning, right? Maybe. But let's look at the other side before we decide. Let's present the bearish case fairly, because there are legitimate reasons to think Burry's move is a warning signal. First, his track record. When Michael Burry gets bearish and steps back, history shows he's often right eventually. In 2005, when he started shorting housing, people thought he was crazy. 3 years later, he was vindicated spectacularly. Second, the market environment. Several high-profile investors are navigating a market that has become increasingly hostile to bearish views in recent years, thanks to unfettered optimism around technology and strong interest from retail investors. Hindenburg Research shut down earlier this year. Jim Chanos, famous for calling Enron, has been struggling with bearish bets. So Burry's not alone in finding this market difficult. When multiple legendary short sellers are either closing up shop or getting pushed out, that could signal something. Third, his specific concerns about tech accounting. If he's right that companies are stretching depreciation schedules to inflate earnings and those earnings are justifying massive valuations, then when the accounting catches up, stock prices could crash. That's not a crazy thesis. It's happened before with different accounting tricks. Fourth, the timing. Why now? Why close the fund in November 2025 specifically? Is he seeing something in the data that retail investors aren't? Does he have information or analysis suggesting trouble ahead? The bearish interpretation says this: Burry sees a market disconnected from fundamental value. inflated by accounting games and irrational optimism around AI. And he's choosing to return client money rather than navigate what he believes will be a devastating correction. He's protecting his investors by getting them out before the crash. That's one way to read this situation. And I want to be clear, it's not an unreasonable interpretation. Burry's concerns about tech valuations and accounting have merit. His track record commands respect, and market warnings from legendary investors shouldn't be dismissed. But there's another interpretation, and this one's based on how hedge funds actually work and what Burry himself has said and done recently. Here's what the panic headlines aren't telling you. Closing a hedge fund doesn't necessarily mean you think the market's about to crash. It can mean a lot of other things. Let's start with what Burry actually wrote. My estimation of value in securities is not now, and has not been for some time, in sync with the markets. Notice what he didn't say. He didn't say, the market is going to crash. He didn't say, get out now. He said his value assessment isn't aligned with market prices. That's actually a very different statement. It means he can't find investments that meet his criteria at current prices. Not that prices are about to collapse, but that he can't deploy capital effectively given his investment philosophy. Think about this. If you're a value investor and everything's expensive by your metrics, you have a few options. You can hold cash and wait. You can compromise your standards and buy anyway. Or you can return the money to investors and tell them, I can't find good opportunities right now. The third option is actually the most honest and client-friendly approach. But it's not dramatic. It's not a crash prediction. It's a guy saying, I can't do my job effectively in this environment, so I'm stepping aside. Now, here's the really interesting part. On social media, Burry posted, on to much better things, Nov 25th. What does that mean? If he thought the market was about to crash and wanted to warn everyone, would he be cryptically teasing better things ahead? Reports indicate Burry named Phil Clifton as his successor and advised investors to contact Clifton regarding future investment endeavors. That suggests this isn't about running away from disaster. It's about transitioning to something else. There's speculation he's moving to a family office structure. That means managing only his own money, not outside investors. Why would someone do that? Several reasons. You avoid regulatory hassles. You don't have to file public disclosures. You can make longer-term bets without worried investors calling you. You have complete freedom. For someone like Burry, who's notoriously independent and contrarian, a family office makes perfect sense. He can still make his bearish tech bets, but without the overhead and constraints of managing other people's money in a registered fund. Also consider this. The fund only managed $155 million in March. For a name as big as Michael Burry, that's surprisingly small. Managing small amounts of money with high overhead and regulatory requirements might not make economic sense, especially if you're constantly battling market sentiment and dealing with impatient investors. Look at what happened with his tech shorts. He disclosed bearish wagers on Nvidia and Palantir, which drew responses from Palantir's CEO and created public controversy. When you manage outside money in a registered fund, every position you take becomes public through quarterly filings. That limits your flexibility and can even work against you as companies and other investors react to your moves. So maybe this isn't the big short investor predicts crash. Maybe it's the big short investor is tired of running a small hedge fund with all its constraints and is moving to a structure that gives him more freedom to invest his own capital however he wants. That's way less dramatic, but it might be way more accurate. So which interpretation is right? Is Burry warning us about a crash, or is he just restructuring how he manages money? Here's my take after looking at all the evidence. It's probably both, and neither. What I mean is this. Burry clearly thinks current market valuations, especially in tech, are disconnected from fundamental reality. He's been vocal about that. He's putting his money where his mouth is with bearish bets. That's genuine concern about valuations. But closing the fund isn't a crash prediction. It's a business decision based on his inability to find value investments at current prices, combined with the hassles of running a small registered fund. If he really thought a crash was imminent in the next few months, would he be taking 6 weeks to liquidate and return money? Would he be teasing better things on November 25th? Probably not. He'd be screaming from the rooftops and getting people out immediately. So what should you actually do with this information? Let me give you a framework instead of instructions, because I'm not your financial advisor and don't know your situation. First, understand that Burry's concerns about tech valuations aren't crazy. Whether you agree or not, the thesis that some tech stocks are overvalued based on optimistic accounting is worth considering. That doesn't mean they'll crash tomorrow, but it means doing your own homework on what you own. Second, diversification exists for exactly this scenario. If you're heavily concentrated in a few high-flying tech stocks because they've been going up, maybe that's worth reevaluating. Not because Burry closed his fund, but because concentration is always risky. Third, not in sync with markets doesn't mean wrong. It means different. Burry was not in sync with housing markets from 2005 to 2007. He was right, but he was early. Being early feels exactly like being wrong until suddenly you're right. so his value assessment might be correct long-term even if prices keep rising short-term. Fourth, don't make investment decisions based on one person's move, even if that person is Michael Burry. He's been spectacularly right before. He's also been wrong. He made huge returns on the housing short and struggled for years afterward. Nobody's always right. Fifth, if you're worried about market valuations, there are defensive strategies that don't require selling everything in a panic. Rebalancing toward value, increasing cash positions gradually, adding alternative assets, setting stop losses. These are all tools that let you reduce risk without timing the market. And finally, remember that market warnings are everywhere, all the time. Someone's always predicting a crash. When it happens, those people look like geniuses and everyone forgets the 100 times they were wrong before. Burry's different because his 2008 call was so spectacular, but that doesn't mean every move he makes is a 5-alarm fire signal. Let's zoom out and look at what's really happening in markets right now. Because whether Burry's fund closure is a warning or not, understanding the environment matters. Several high-profile short sellers and bearish investors are facing pushback or shutting down due to unfettered optimism around technology. That's a fact. Hindenburg closed, Chanos is struggling, Burry's stepping back. What does that tell us? One interpretation is that pessimists are being proven wrong by a genuine technological revolution and should be ignored. Another interpretation is that markets have become so momentum-driven and sentiment-based that fundamental analysis doesn't work anymore until it suddenly does in a violent correction. The truth is probably somewhere in between. AI and tech advances are real. They're creating genuine value. But that doesn't mean every company with AI in their pitch deck deserves a sky-high valuation. Both things can be true. Burry's specific beef about depreciation accounting is actually worth understanding, whether you're bullish or bearish. When companies buy massive amounts of hardware for cloud infrastructure and then spread the depreciation over many years, it makes near-term earnings look better. That's legal. It's standard accounting. But it does mean reported profits might be higher than they would be with faster depreciation. Does that matter? Maybe. Maybe not. If the hardware actually lasts and generates revenue for many years, slower depreciation is appropriate. If it becomes obsolete faster than expected, then earnings will eventually have to catch down. This isn't fraud, it's accounting judgment, but it's worth being aware of. The broader point is that Burry's concerns, regardless of whether they justify closing his fund, are highlighting real questions about valuation and accounting that every investor should be thinking about, not panicking about, thinking about. Here's another angle nobody's talking about. What if Burry's moving to a family office specifically so he can make bigger, longer-term bearish bets without having to worry about quarterly redemptions or public disclosure? If you think a bubble takes 3 years to pop, managing outside money in a registered fund is terrible. Investors get impatient, they see their friends making money in the bubble, they redeem. By the time you're proven right, you might not have any capital left. But if you're managing only your own money, you can wait however long it takes. You can double down when others panic. You can be contrarian without consequences. That's actually a bullish sign for Burry's conviction, not a bearish market signal. So let's bring this all together. Michael Burry deregistered his hedge fund, Scion Asset Management, effective November 10th. He's returning all client capital by year-end. He wrote to investors that his value assessment isn't in sync with current market prices. He's been vocally bearish on tech valuations and accounting, and he's teased moving on to much better things on November 25th. Is this a market crash warning? Possibly. Is it just a business restructuring? Possibly. Is the truth some combination of both? Probably. What we know for sure is that Burry sees current valuations as disconnected from what he considers fair value, particularly in tech. We know he's closing his registered fund and likely moving to a family office structure. We know he's placed significant bearish bets on companies like Palantir and Nvidia. And we know he's done this kind of thing before, closing his original fund after the housing crisis. What we don't know is whether this time will be like 2008, where he's spectacularly vindicated, or like the years after, where his bearish views cost him. Markets can stay irrational longer than you can stay solvent, as the saying goes. And Burry himself has experienced both sides of that equation. So what's the takeaway? Don't panic based on one headline. Don't ignore legitimate valuation concerns either. Do your own homework. Understand what you own and why. Have a plan that accounts for different scenarios. And remember that the best investors are often the ones who can wait patiently while everyone else panics or celebrates. Burry's closing his fund. That's interesting. It might be significant. But it's not a crystal ball. It's one data point among thousands. Use it to inform your thinking, not to dictate your actions. If you found this breakdown helpful, let me know in the comments what you think Burry's up to. Is he warning us about a crash? Is he just going family office? Or is there something else we're all missing? Drop your take below. And if there are other financial stories causing confusion or panic that you want me to investigate like this, let me know those too. I read the actual documents, so you don't have to, and I separate fact from hype so you can make informed decisions. Hit subscribe if you want more of these deep dives. And remember, this isn't financial advice. It's information. What you do with it is up to you. Thanks for watching. See you in the next one.